Welcome back to the Audit Guidebook channel. Today, we're diving into Module 2 of our Practical Guide to Audit, and we're tackling a word you're going to hear every single day in this profession: risk. But what does it really mean for an auditor? Let's break it all down. So, whether you're deep in your studies, just starting your first audit gig, or hey, even if you're a seasoned pro just looking for a quick brush up, this explainer is for you. Because, let's be real, getting a handle on risk, it's absolutely non-negotiable. Okay, first things first, we've got to get our definitions straight. In our world, risk is so much more than just a buzzword. It's pretty much the foundation of everything we do as auditors. So nailing this core concept is super important. So when we're looking at an internal control system and we say risk, what are we actually talking about? It's not just some vague, I've got a bad feeling about this kind of thing. Nope, it's about pinpointing very specific things that could go wrong. To put it really simply, risk is the chance that something's going to go sideways. The potential for errors to creep in, for someone to commit fraud, or for any kind of loss that could hit the company's bottom line. All right, now let's get a little more formal. Pay close attention here, because the professional definition links risk directly to an organization's objectives. And that, right there, is the key for us as auditors. Risk isn't just some abstract problem. It's something that can literally stop a company from achieving its goals. Okay, so now that we have a solid definition, let's start peeling back the layers. To really get a grip on risk, you've got to know where it comes from and what different flavors it comes in. And the thing is, risk can pop up from just about anywhere. It might be something internal, like controls that are just not great, or someone making a simple mistake. But it can also come from the outside world. Think new laws, a shaky economy, things that put a whole new kind of pressure on the business. So with all these potential sources, how do we make sense of it all? Well, auditors don't just throw everything into one big bucket. We actually have a system for classifying risk, which lets us analyze it with a ton of precision. And trust me, this is fundamental to how an audit works. First up, we've got this pair: inherent risk and control risk. Think of it like this. Inherent risk is the raw, unfiltered risk that's just there before you do anything about it. It's like walking a tightrope with no safety net. Control risk? That's the risk that the safety net you did put up might fail. Maybe it has a hole in it, It won't actually catch you if you fall. And that brings us to the big one: residual risk. Here's the deal. You can have the best controls in the world, but you can never, ever get risk down to absolute zero. It's just not possible. So that little bit of risk that's left over after all your controls are in place, the stuff that management basically says, okay, we can live with this, that's your residual risk. So, this is a perfect segue into the other half of this puzzle: controls. If we're thinking of risk as the problem, then internal controls are our answer. They're the strategy we use to wrangle that risk and bring it down to size. But what's the point of all these controls, really? Well, they're typically aiming for three main things. Number one, making sure the financial reports are actually reliable. Number two, helping the business operate effectively and efficiently. And number three, pretty straightforward, just keeping the company compliant with all the relevant laws and regulations. Okay, that's enough theory for a minute. Let's make this real. We're going to walk through a super practical example involving a microfinance bank to see how all these pieces actually fit together in the real world. So let's think about this bank. What's the inherent risk? Well, before they have any rules or reviews in place, there's a huge risk that they'll just give out loans to clients who aren't qualified, right? People who can't pay it back. That could cause some serious credit losses. That's the raw, no controls yet risk we were talking about. So how do they deal with that? They put a control in place. For instance, they might require that an independent officer, someone separate from the person originating the loan, has to review and approve every single application. That adds a really critical second set of eyes. And the result? Well, that control seriously cuts down the risk of making a bad loan. Now, is it foolproof? Of course not. A bad loan could still get through the cracks, but the risk is now at a much, much lower level. And that little bit of risk that's still left? Yep, you guessed it. That's our residual risk. All right, let's pull all this together. We've defined what risk is, we've broken it down into its different types: inherent, control, and residual, and we've seen a real-world example of how a control can knock it down. And all of this leads to a massive, critical question that every single auditor and business leader has to grapple with. We know there's always going to be some residual risk left over. The real question is, how much is too much? Where do you draw the line? Answering that is what risk management is all about. Hey, if this helped you get a better handle on the concept of risk, do me a favor and hit that like button and subscribe to the Audit Guidebook channel. We've got a lot more coming in our Practical Guide to Audit series. Thanks so much for tuning in, and I'll catch you on the next one.